Hello, everyone. This is Dr. Duru from Ahan Analytics with the market breadth. We had a packed week, and the market continued its melt up thanks to the US and China pretending that they like each other and that all is well. Well, that allowed us to continue moving higher until the Fed had something to say. Powell balked at a rate cut in December, and that caused some wobbles in the stock market. When we get to the charts, you'll see what happened. If you want my opinions on the Fed's latest policy moves, I put a link down below to my blog on Inflation Watch. Otherwise, I'm going to go through a completely full menu of stocks, so hang in there. I had to write them down even. I'm going to first cover the consumer-facing stocks. This is where we're seeing a lot of key and important weakness. Then we move on to big cap tech, where we saw a bunch of what I call gap and crap moves, which are some signs to me that we're going to at least have some choppiness in the first few weeks of November instead of this steady melt up that we've been enjoying for so long. AI, of course, has to be part of any agenda. So I have a few there and some key stocks, so hang in there for those. Finally, I'm going to end off with some other stocks that had some key moves and where I made some key trades that you might be interested in learning about. Okay, let's get into it. Let's take a look at the important indices. This is market breadth, and this is why I called this segment the edge of a breakdown. So market breadth, the percentage of stocks trading above their 50-day moving averages, what I like to call AT50 for above the 50, is trading right now at 41.4%, and it's barely holding on to its low that it hit earlier in the month when we had that big one-day sell-off. And this big circle is showing this region of big chop and churn. The main point here and lesson that you have to take away from this is that the majority of stocks and the individual stocks in the stock market are either bearish because they are breaking down, or they're bearish because they're in downtrends. Breaking down meaning below their 50-day moving averages. That's an important trend line. And so I don't think that the underlying health of this market is strong. And I did a YouTube short on this, and you could check that out if you want to get more details. Fortunately, though, the percentage of stocks trading above their 200-day moving averages, what I like to call AT200, of course, is looking much better. So it's not quite towards the low of October, but it is below this nice range that it was at the highs of the year. So this is what I am now also keeping an eye on, because if AT200 goes below this October low point, that's going to be pretty bearish for the stock market as well. Okay, so these are the things that I'm keeping an eye on in terms of market breadth. I think a market breadth's edge of a breakdown. Okay, so now let's take a look at the VIX. The VIX, if you recall from previous videos, I mentioned how there was tension building because of this bowl shape that was pressing up on the VIX, and it did indeed break out earlier this month. And almost like clockwork, this big, let me zoom in here for you, this big fade in the VIX signaled the top, but now look what's happening. The descent has stopped. And in fact, there's some consolidation going on right here in this period. This to me is the VIX regaining its energy. And it would make a lot of sense for the VIX to jump again, because we've had things so good for so long, and these other VIX spikes have been so short that we haven't really exercised much selling pressure or shaken out motivated sellers from the stock market yet. So this is something to keep an eye on. Even though August, September, and October are the stock market's most dangerous months of the year, and I'll put a link to that also in the captions, what was I going to say? Oh, right. The performance of all three of those months was pretty good, and the drawdowns were not that impressive. So I expect there could still be at least a lot more chop that lasts longer than we've had in the past, where we've just enjoyed this almost persistent melt up. Okay, so that's the thing to keep an eye on. All right, let's jump into the indices. S&P 500. It was just at an all-time high. The Fed ruined things a bit. So the last all-time high was on Tuesday. The Fed was on Wednesday. You could see if I zoom in here, the sellers actually jumped right into the S&P 500. It almost reached the opening price for the week before sellers pushed it back to a flat close. And then the sellers came back in force the next day, got a 1% drawdown on the S&P 500 out of it. Now, things are hanging in there, but you could see that this is a precarious point for the S&P 500 where a retest of the 20-day moving average uptrend almost seems in the cards in the next week or 2 weeks or so. And then, of course, the 50-day moving average was never really quite tested in the last pullback. So there could be an overdue moment for the S&P 500 on a true test of that support line. But who knows when that's going to come, right? Because overall, the market is very bullish. And I even switched from neutral to bullish for my short-term trading call. The NASDAQ is very similar, but it's actually stronger than the S&P 500. So even on the Fed day, the NASDAQ gained 0.6%, hit an all-time high on that day, unlike the S&P 500. It did get knocked down the next day by 1.6%. And you'll see why when I go into the big cap tech stocks, but then it bounced back. In fact, it had a nice gap up today and closed up 0.6%. So this was part of what I think held up market breadth. Now, IWM, the ETF of small caps, unfortunately, is back to laggard status, sold off for most of the week. It did hold its own on Friday at 0.6%, but you can see it's almost certain in a few days to test this convergence of the previous all-time high and the 50-day moving average. I'm, of course, betting that this will hold. I do have a fresh set of IWM calls in play. It's going to be a close call given they expire next Friday, but we'll see what happens as always. And just as a reminder, I provide this content for educational purposes. Please trade and invest with your own risk management and timeframes in mind. Share and like this comment. It helps the algorithms know what's up. Subscribe to this channel if you want more content like this. And of course, I'm always open to feedback and comments. So you can put those down below. Now, let's dive into the individual stocks. As I promised, we're going to start with the consumer-facing stocks. Chipotle Mexican Grill, CMG, bad earnings reaction on Thursday, 8.2% drop, 2.5-year low. If you want to just put a pause on the video, here are all my notes from previous key moments for CMG, Chipotle Mexican Grill. I won't go into these in detail, but just notice, this is going to be very important because Netflix just announced a 10-for-1 stock split. This 50-to-1 stock split, and I warned about this back then, was essentially the beginning of the end. I mean, look at how good Chipotle had been doing up until that point. And it had just one last gasp higher, and then it's been choppiness all the way down. Now, I decided at some point in here to stop trading it in and out and just taking quick profits and just commit to a longer term position. So this earnings collapse was not in my radar, but I was prepared for it because my position is not that big. I'm also not in a rush to add more shares because I think now Chipotle is essentially dead. It's going to be dead money for a while. The company is not doing well. It says young people without jobs aren't eating their food. Next, it'll be young people, period, right? So this is like step by step, things are deteriorating. And this is also a sign of one more confirmation signal that while AI is doing great and capital investment is doing great, individual consumers are not doing that great. And so a lot of consumer-facing stocks are facing troubles like this one. And for further confirmation, let's look at the restaurant index. And believe it or not, there is a bunch of them. And we're going to look at just the US benchmark from the NASDAQ. And you can see that this index is at a new low for the year. And in fact, it's at a 14-month low. So this is very bad. This is confirmation that the consumer is pulling back on discretionary items like going out to eat, restaurants and bars, because that's considered luxury right now. People as an alternative could, of course, just cook at home and buy their alcohol at the local liquor store and have at it and have fun right at home. So this is confirmation of that. I'm going to drive into a lot of other consumer-facing stocks here. Coursera, ticker symbol COUR. I wrote about this. I took a chance holding a position into earnings. Didn't work out. 13% post-earnings drop. This now completely reversed the 36% post-earnings gain from July, which gave me hope that this stock had finally turned the corner. It is not the case. It confirmed a breakdown below its 200-day moving average, which is this blue line. So I just bailed, took the loss. This is basically a broken stock. I'm not going to be pulled in again, buying the dips on this one. I'm just going to keep an eye on it. I mean, Coursera is a great company, but clearly the business is not doing as well as it could be. And just to give you perspective, this is where Coursera has been, right? It was trading as high as 62 soon after its IPO in 2021. So this is a very, very broken stock. I don't think they're going to go bankrupt, but it's just not going to be a good place to invest. Maybe some quick trades, but it's not an investment. Also on the educational side, this is another bad sign for companies like Coursera, is that Stride Incorporated, ticker symbol LRN, they do educational software, completely collapsed, 54% post earnings earlier this week. I think this was Wednesday. I mean, this is about as bad as it gets, right? The stock was cut more than in half. Interestingly, this drop only took it back to a 52-week low. This is how good it had been doing before. Let's just scroll back. You can see how well this stock has done over the many years. So this is a big setback for the company. In fact, I think it's the biggest setback for the stock, period. This is a very, very broken stock. I do keep an eye on it because I do like this company. I've never traded it or invested in it, but now I'm very intrigued to see if this stock can make a comeback. And how will I know it's making a comeback? Well, one key thing would be to put in a second close higher. Even better is to trade above a key intraday high like the day after earnings. And then even better is getting to a new post-earnings high above the intraday high since the earnings collapse. So this is going to probably be a process. No, I'm not in a rush, but I am going to keep an eye on this one. DraftKings. Now, DraftKings stock's not doing well, but it's because of competition. We all heard probably the term degenerate economy. The degenerate economy is alive and well. That's why all these companies are rushing in to provide their own betting and prediction market options. What dragged down DraftKings this past week was Polymarket is coming in to the U.S. to do U.S. sports betting, and that's extra competition for the likes of DraftKings. On that day of an announcement, it dropped 5.5%, and it continued to sell off until today's little feeble 1.5% gain. Looks like earnings are coming up next week. I am going to be watching closely because you can see if I drag back, DraftKings is clinging to the very bottom of a trading range that has been in place for almost 2 years. So this is a very critical juncture for DraftKings, ticker symbol DKNG. Another big collapse was in Fiserv. This is actually a fintech company, but again, this is another example of a stock that has been dragging down on market breadth. You can see it's been below its 50-day moving average for months. And this is an example of a stock that I warn about all the time. I mean, this company has consistently gone down. Look at this. Look at these earnings reports. The last two big drawdowns on the last two earnings reports, a steep downtrend. So trouble had to be coming. And it looks like everything came to a head at the last earnings report, massive 44% post-earnings loss. I believe there's going to be some restructuring amongst the leadership. So this is a situation that maybe this is as bad as it gets. But again, just like I said with Learn, ticker symbol LRN, I want to see the buyers really express some true interest with some higher highs coming off of this catastrophic low. All right, SE. This is an interesting one too because it is internet e-commerce. It's consumer facing, but it's mostly, I think, in fact, all of its business is in Asia. It just fell out of nowhere. I have a price alert on SE. This is C Limited. And I have a price alert and it suddenly fell. And I looked and I couldn't find any news. It dropped 9.6% on the day. And then right after that, Bank of America tried to save the stock, came out with an upgrade, slapped a $215 price target on it. It was good enough for the stock to gap higher, but then sellers took over and then closed it out below the low of the previous day. Let me zoom in so you can see that action. This is technicals live in full effect, right? and the sellers have pretty much dominated trading. It's slowed down a bit as the 200-day moving average approaches. I really want to be there to see what happens when this company reports earnings, because it seems like something is up. There's no news yet to explain any of this renewed selling interest in C Limited. And I do not want to buy until the air is clear on what in the world is worrying the market right now for SE. Another big drop was in SPS Commerce. This was a 21% post earnings loss to a 5-year low. Very ugly. This is another stock that was warning downtrend the entire year. Big gaps, big sell-offs earlier, including a big gap down. And maybe things have come to a head, but for SPS Commerce, this is a very dangerous place to be. Buyers did pick up the stock strong off of the lows. It traded as low as 74.12 and gained essentially 10% from there. So that's encouraging for a bottom. And if I were speculating on the stock, I would buy here and then just stop out if a new low, intraday low, was hit. But I don't want to take a risk on this one. Too many good stocks in the stock market to jump into. UPS. Here's a consumer-facing stock that actually it may be turning the corner. Now notice this downtrend is really ugly. It's been in place for almost 4 years. Essentially, it's been in downtrend for 4 years. The only reason that I got interested in it is because it's right here at the pandemic lows. That to me just seems so overdone. So my first step was to buy shares, and I sold a call option against it ahead of earnings. The stock soared 8% post earnings, but you can see very suspiciously technicals are looming in. This 200-day moving average, this 200-day moving average, which is the blue line, is in a downtrend. And look how conveniently the stock stopped just short of that resistance and has been tentative ever since. So that means that the downtrend is still intact. And but what I'm betting on is that it's gotten as low as it can go. That's not a prediction. That's the trade that I've taken the risk to basically see whether that is actually what unfolds. Now, we do have an exception for consumer-facing stocks. This is Wayfair, ticker symbol W. It sells online home furnishings and furniture in particular. It's not the kind of business I would think would be thriving in a place where the housing market is slow, consumer spending, sure, it's pretty strong, but the consumer is supposedly slowing down and employment's not looking great. But here it is, 23% post-earnings gain, 3.5-year high. So there's always going to be exceptions. There's always going to be the beautiful house in the ugly neighborhood. Wayfair is that beautiful house in the ugly retail neighborhood. Finally, there's Garmin. They sell basically navigation-related devices. This is mostly, I think, consumer-facing still. And you can see that it had a bad drop post-earnings, 11.5%. Broke below its 200-day moving average support, and now it is in bearish territory because of that. I don't want to chase Garmin as a short, one, because I'm still bullish on the market, but two, this is the kind of stock that I think could just pop out of nowhere and really damage a short position. So I'm just going to keep an eye on it, see what unfolds. And that's it for the consumer-related stocks. Let's go ahead and jump into big cap tech, what I'm going to call the gap and crap section. And let's take a look at why. So I'm going to start actually with Meta. Meta was just plain awful. So this is another example of a stock that's been dragging on market breadth and is warning that the market is on the edge of a true breakdown, a potential breakdown. Meta Platforms, ticker symbol META, post-earnings drop of 11%, slice right below, gap right below its 200-day moving average. Today, it tried a rally, gapped up. It tried to retest that, failed, and actually sold off again 2.7%. This is truly bearish action for Meta. Why are people worried about Meta all of a sudden? Well, they promised to spend even more money investing in AI infrastructure and in their AI developments. And, and investors are getting antsy because cash flow is being spent up on this. I think probably cash hoards are shrinking because of all this spending, and the returns are not there yet. So there's only this hope, right? The reason why I led with Meta is because this is a truly bearish reaction. And I've been warning about Meta for quite some time, ever since it did this gap and crap to a new all-time high back in, what was this, back in June. It surprised me on earnings. It popped 11%, but it didn't make much more progress after that. And this former all-time high continued to loom large. You could see how Meta was pivoting around that, and now boom, earnings have confirmed that Meta is topping out for now. All right, so let's continue with our big cap tech. Microsoft also had a bad day. Strange, interestingly enough, it gapped high right before earnings. What was this? A 2% gain. Stopped just short, right, of this post-earnings gap and crap. You're starting to see the theme, right? The big cap tech stocks are printing a lot of gap and craps. We got to take note. These are warnings. They're yellow flags. They're not all bearish, but they are warning signs that we need to heed. And so this gap and crap signaled a top in Microsoft back at the last earnings. This gap and crap right ahead of earnings couldn't break through that resistance. So that was a bad sign. And now post earnings, it lost 2.9%, perfectly tested the 20-day moving average support, which is this dotted line. Let me zoom in here for you. And then today it fell again 1.5%. Now I am long Microsoft for the long term. I have a long-term position, and I am eyeing this for a short-term trade as well. So I'm not bearish on Microsoft, but I am cautious because it seems like Microsoft is topped out for now. Okay, so topping out doesn't necessarily mean bearish, because a stock index, whatever, can top out and just churn for weeks and months at a time without technically being bearish. So Microsoft is not bearish. Meta is bearish. Microsoft is not. Google, guess what? It looks great except for this gap and crap. 2.5% post earnings gain. It gapped up, crap lower. And just in case, sorry, you missed that, gap is when it creates space between the last close and the open. That's the gap. Crap is when sellers jump right in and take the stock down well off of the intraday high. So that's the gap and crap. But Google did end the day with a 2.5% earnings gain, and it held its ground today, whereas the other big cap tech stocks had big down days. So Google's still looking good, even though it's still overextended. You can see how it's been riding this upper Bollinger Band, which defines one standard deviation around the 20-day moving average in terms of the price action. Next, big cap tech stock, Apple, ticker symbol AAPL. I had a pre-earnings trade going here. I'm going to write more about it on my blog at drduru.com/122. Just note for now that Apple is above its former all-time high, so that's good. Let me extend out the line here. Give me a second. Extend that out. And what I didn't like is that, in fact, this is almost like a bearish engulfing pattern, topping pattern. Another gap and crap for Apple. And in fact, it crapped out so much, it actually ended the day with a 0.4% post-earnings loss. Again, I won't go into the mechanics of the trade that I put in, but it was a low-risk trade. And if I had been able to get out of it right at the open, everything would have been fine. I rolled over the position. We're going to try again next week and see what happens. I think there's some mixed signals from Apple. This iPhone 17 caused a lot of excitement. Their wins there, but then some of their actual results in China, I think, were lighter, a little on the light side. So mixed signals, but I think Apple is back on track. As long as it stays above its former all-time high, it's all good. Now, last big cap tech, sorry, not the last one, but the last kind of in this gap and crap series is Amazon. Guess what? 9.6% post-earnings gain, but gap and crap. So all of these big cap tech stocks, gap and craps, they're all topping out in one way or another, sometimes with bad results and sometimes with good results. I'll just say that I had a post-earnings bearish trade on Amazon. I was really fooled. I really thought that Amazon is a pretty weak stock. It had this 200-day moving average breakdown, which turned out to be a fake. It recovered from that very quickly. It went straight up, and then right before earnings, it actually lost 3.2%. I almost took a profit on my pre-earnings bearish position on Thursday's drop, But because I had it paired with Apple, I wanted to stick to the original plan. So that's just the way the ball bounces sometimes. So Amazon's at an all-time high. If it can at least hold this former all-time high, just like the other big cap techs, this could be the major turning point. So if it closes below that, that will, for me, confirm that Amazon is actually topping out. So this is the spot to keep an eye on. The last big cap tech stock in this list is not a gap and crap because it did gap up, but it didn't crap post earnings. But what it has done is slowly crapped out. So look at Oracle here. Here's the former all-time high. Again, the power of technicals, right? Look at how magically it stopped cold when it fell down 6.7% on Thursday. The sellers couldn't push it below the former all-time high. And then today, while the other big cap techs were mostly selling off, Oracle was able to bounce 2.2%. But still, it is officially in bearish position now. It's below its 50-day moving average. It needs to recover this before getting back into my bullish graces. But for now, and particularly if it falls below the former all-time high, we might as well kiss the last bit of this gap higher goodbye. And then the next thing is to see, well, can buyers at least defend the bottom of this gap? Because if they can't, I think Oracle could quickly fall all the way back to its 200-day moving average, which it was just at back in May. So that's the technical setup. Warnings galore for Oracle, but all will be forgiven if it can recover the 50-day moving average. Now, Oracle, of course, is an AI play now. Let's take a look at the AIs. I'm going to show you an unconventional AI play, which is Caterpillar. Caterpillar is now officially in the AI camp because it soared, what was this, 11.6% post earnings. And guess what the news was? Well, they said that they are selling heavy equipment, heavy machinery like hotcakes because of all these data centers that are being built. And why are the data centers being built? They're being built because of, they're being built because of the need for AI. So Caterpillar, believe it or not, is an AI play. I'm going to put it in my AI bucket. It has been bullish for a long time. I have just not taken enough advantage of this uptrend. After, technically when a stock invalidates a topping pattern, it's going to be bullish. And this is just a classic invalidation breakout and continuation run. So Caterpillar looks great. Let's see what happens when price cools off a bit. But this is firmly in the bullish camp, as a lot of AI is. Qualcomm jumped into the AI race, announcing chips that aren't going to be built and ready until next year, and then a second chip the year after that. But that's just how strong and compelling the AI story can be. You could just talk about plans and your stock will soar. Now, Qualcomm, interestingly enough, it did gain a good 11.1% on that day of this announcement, but look at how high it got. It was actually up as high as 206 before fading all the way back to 188. So this tells me that Qualcomm's probably topped out. The AI hype has done its work. Probably Qualcomm is not going to erase the entire length of this gain. You can see buyers did jump in on Friday, and actually this could be a 1, 2, 3 pullback that's going to slingshot Qualcomm to try to challenge this $206 level. So I'm going to keep an eye on it. I might trade it next week, start trading it next week. Unfortunately, earnings are going to be coming up really soon, so I don't want to trade in front of earnings. I might even wait until after those are done. Now, despite that big spike, Qualcomm still has a ways to go to get to its all-time high, which was 229 set last year. Okay, Qualcomm, ticker symbol QCOM. Here is a play that I did by pre-earnings, and it worked out okay. It worked out well, 12.6% post-earnings gain. This is SPX Technologies, ticker symbol SPXC. Great gain. This was a stock that was profiled in a video that I showed, a video that I put together explaining why I wanted to hold on to. A video where I was talking about where the jobs are, and the jobs are in the data centers. They're in power management and heat management in those data centers, and SPXC, SPX Technologies, is part of that. And so I went ahead and bought in. The story was compelling from that video that I included in my video clip. And I also like this action, nice price consolidation, just the rubber band being stretched, being pulled, sorry, the spring being compressed before the big pop. So now this stock is at an all-time high. I'm planning on holding this for the long term meaning as long as this AI data center synergy is working out. So I am very bullish on SPXC, and I plan to hold it as long as I can. Here's one that I should have held on longer, but I could not. This is Cloudflare, ticker symbol NET, 13.8% post-earnings gain, new all-time high. I really like what Cloudflare is rolling out, which is an engine or a software platform that's going to help publishers monetize AI traffic that's scraping their sites or pulling their information and language to train models. I think that's going to be an important gatekeeping function that's going to allow web publishers to stay alive and survive. But it's also going to be good for the whole ecosystem because it'll motivate people to create content that will then make these AI models, keep these AI models useful for the rest of us. Now, the reason why I took profits earlier in Cloudflare is because I just started getting uncomfortable with its extremely high valuation. I just couldn't get with it. So, more power to Cloudflare if it just keeps going up to infinity from here. But the valuation was just too rich for my blood, which for me means too much downside risk if something were to go wrong. All right, we're coming towards the end. I have a few other stocks to show different stories. C.H. Robinson Worldwide. This is a trucking and I think a shipping company. New all-time high, 19.7% post-earnings gain. This is pretty amazing. This is a good economic signal, at least for the segment that CHRW plays in. I might be interested in buying the dips on this one. Certainly not going to chase this big surge, but you can see how bullish this move is because it was clinging to 50-day moving average support or resistance, depending on your perspective earlier. And now it's cleared all of that and just needs to consolidate or pull back a little bit and set up the next big rally. Illumina, ticker symbol ILMN, is a biotech stock that I used to be in. I can't remember the details of the trade too much, but now I really want to get back in. And why? Well, let me pull back and let me show you what's been going on here. Check this out. I think Illumina is doing a bearish to bullish reversal. So notice I'm drawing this bowl again to show the biased, the price pressure's bias is to the upside. Illumina has now filled its post-earnings gap down from February. That's bullish. It's cleared a new high. That's bullish. And the springboard was this convergence, rough or loose convergence of the 50-day moving average, 20-day moving average, and the 200-day moving average. So everything is looking up for Illumina now. Bullish, bullish, bullish with this 24.8% post-earnings gain. Of course, I'm not going to chase it. I'm going to look for some price consolidation, even a pullback, but this is turning the corner. So I want to get back into accumulation mode in Illumina. Finally, ticker symbol BAH, Booz Allen Hamilton Holding Corporation. I've written about these stocks in the past. It just makes sense that these management consulting companies are under pressure because the government is pulling back on its spending on contractors and on companies like this. They told a good story earlier, tried to hang in there despite all the government cutbacks. But, the writing is on the wall. Booz Allen Hamilton last year was as high as 190. It's been cut more than half. But what got me interested, I've been keeping an eye on these because I think that the selling is overdone in terms of the long-term prospects. I think these companies will get back on their feet. Their services will be needed for all sorts of reasons, particularly when it comes to AI. But I did jump back in as soon as I saw this news that the president and CEO of Booz Allen Hamilton loaded up on $2 million worth of shares. That's all I need to see. I don't even care if the stock dribbles down below the low of today. I just don't want it to go to a new low. If it goes to a new low, that tells me, okay, maybe the company's troubles are much bigger than even I can comprehend. I better step back. But for now, I'm really encouraged to see the CEO and president stepping in such a big way. We'll see what happens, of course. The stock has a long way to go to heal and repair. All right. Thanks a lot for checking out the market breadth. Again, remember, the warning signs are out there that we should not expect a melt up to just continue all the way smoothly into the end of the year. Some chop at a bare minimum is on its way, if not an outright pullback. The market even needs at least a 5% correction, if not a 10% correction. I mean, those kinds of things are just normal. I'm not projecting one. I'm not looking for one, and I haven't positioned trades for that. But I am on edge. Again, let me just show you why I'm on edge. Because shorter term market breadth is just not healthy, and it hasn't been healthy for quite some time. It's been trending down, and now it looks it's right on the edge of a breakdown. If it breaks down, I'm gonna have to pull back on my bullish trading call, go back to neutral, and maybe even to bearish if we get breakdowns in the indices below the 50-day moving averages. All right, remember, hit that subscribe button, and I will see you the next time I post. Thanks a lot for checking in. Take care.